Why is whaling similar to the VC industry? And the reason why is that hunting whales is risky. So either you hunt a whale, a big one, or you didn't. And it's a lot of risk. But if you hunt a whale, you get a lot of money and it pays off for multiple ships.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
People are looking for a high ROI. Generally, there's a belief, and this may not necessarily be true, but in the US side especially, that having VC as part of your portfolio will help you beat the public market returns by about 5% over a 20-year period. But having some illiquid, long time horizon, high risk investments is a good way for diversification if you have a very long time horizon. So there's a perspective from a sovereign wealth fund or from an endowment especially. Obviously, diversification as well. You don't know, but you're like, okay, I don't know if buying gold makes sense in the next 6 months, but if I put money in a VC fund, these companies will bear fruit in 10 to 15 years. There's a diversification over time because I don't know what I'm going to do, but I might as well put in tech. And 10 to 15 years, the world may be a better place. Obviously, strategic insights to geography and industry. We see a lot of folks actually in different parts of the world. For example, I do know that I met a VC fund manager from Southeast Asia. He had traveled to Europe, and then he was talking to an LP, a large institutional LP. And the large institutional LP was like, oh yeah, she listens to the Brave Southeast Asia Tech podcast because she's interested in diversifying out of Europe into Southeast Asia. She can't really do China, all these other things, right? But she's interested in Southeast Asia. And so she's learning about Southeast Asia as a region through listening to my podcast. But the reason why she's doing that is also because she's interested in investing in a VC fund that will give her diversification into Southeast Asia, and more specifically into Southeast Asia tech as an asset class. Obviously, not saying that she's going to make that decision, but that's part of her mandate, right? Obviously, it's a sensor network. So for example, if you are a corporate VC, corporate fund, you may choose not to make direct investments. You may not have your own corporate VC fund. You may choose to invest that in VC funds that are more independent than yours because you're saying that I don't want to run this internally. I want to let these independent professionals. And I literally had received a WhatsApp earlier today, but basically there's a company and then they have some market expansion plans to Japan, right? And then the VC fund has Japanese LPs and the Japanese LPs are like, we're interested in this because of the Japanese connection and so forth, right? So there's a sensor network, there's the ears. And of course, some corporate VCs or high net worth individuals may choose to invest in the VC fund first, just to learn the ropes, get to meet the VC fund, understand how it works for 5 years, 3 years, whatever it is. And then eventually they may want to launch their own VC fund eventually as well. So these are 5 general buckets of reasons why LPs may invest. And VCs, as a result, have a certain structure with the limited partners, with the general partners, and the startups. And I think that's how you should think about it in terms of the money flowing down. So the LPs that we talked about, these people who are very rich, or they want to diversify, or they want to concentrate their bets, or they have some sort of mandate to it, they put their money and they pick the VC fund and they provide the capital. And normally they put in 99% of the capital into the company. And in general, there's something called 2 and 20. We'll talk about it more in time to come. But basically, they will get 80% of the upside. So if a $10 million fund, let's say, they $100 million, right? So there's $90 million of gain. The LPs will get 80% of that $90 million. But the key thing is that from a legal perspective, this is governed by something called the Limited Partnership Agreement, which is the legal side of it. So basically, it sets out the covenants, the agreements between both sides of it, between the VCs and LPs. Now, the general partners, and this is a very important term, there's a lot of people who are called partners, but general partners are the ones that are really in charge. So they receive this capital and they agree to invest in startups, right? The limited partners, they're called limited partners because they have limited legal liability, right? Does it make sense? If something goes wrong, fiduciary or whatever, the limited partners don't get any legal liability. But for the general partners, they have unlimited legal liability for bad mistakes, fiduciary, negligence, whatever it is. Now, the GPs will invest 1% into their funds, a $100 million fund, and I invest 1% of it. That means I have to put in $1 million of my own money into the company as skin in the game, right? It's called the GP commit. Now, out of the $100 million, 2% of that fund is given to me every year to run expenses. So out of 100 million, I'll get $2 million per year for the next 10 years to help me run my expenses. And then if that $100 million fund becomes $1 billion, right, $900 million more games, 20% of the upside will go to me. We'll explain some of these economics more, but this is really important. That's why in the structure, it's often called 2 and 20. So the managers get 2% of the fund raised every year for 10 years, and then they get 20% of the upside of the quality of decisions they make. And then, of course, carried interest is treated as capital gains. For example, it is now known that the Saudis are negotiating a lot more harder. So they want a lot more of the upside. They're like, we want you to get paid a salary, but we want more of the upside, for example. So other funds may choose the other way, which is they may choose to have a floor. You must hit a certain level of return before you get a slice of it. And then some of it may be like, some VCs might be like, I want to pay more cash in the early days because in the first few years, I'm doing more work. But now that after I've deployed my investments in the first 3 years, then I'm doing less work, so I should be paid less for this time. So there are some different permutations for these various provisions. But I think the key thing is that 2 and 20 is pretty much the general norm. And then there are different ways to split it. But I would say that in general, it is primarily driven. I think if you're the best VC that's making a ton of money, you get to negotiate those clauses for yourself. They give you more upside. And if you're a very large LP that has a very large check, then you tend to have more bargaining power for these negotiations as well. So I think you got to be thoughtful about that. In general, I think the general yardstick is you need about $25 to $50 million to feed one general partner. So I think there's a yardstick in VC land is because if your fund size is too small, it can't feed the general partner, it can't feed the team, it can't feed the legal requirements. So there's a certain threshold that people have before they can go. So it depends on that as well. I think that Silicon Valley Bank bankroll GP commits. So basically they would help. So Silicon Valley was like, we're happy to, you put up that $500,000, for example, $1 million, because you want to be able to continue sending your kids to school or pay a mortgage, whatever it is. So they would actually have done some of that financing in Silicon Valley. That's one. The other version of that, for example, was they did it for mortgages. So a lot of founders and VCs, a lot of their money is in stock, and you can't use stock to do a mortgage. And so Silicon Valley Bank was the only one that was willing to lend you money for your mortgage in order on your paper stock and share for that. What I'm trying to say here is I think the financial stake is pretty much almost always there. I don't think there's sweat equity for GPs, but historically there were other ways to help finance that as well. I think in general, for example, I wouldn't say for Southeast Asia, but in America, for example, a GP of a new fund might be making only about 150 to 200 grand US. I think if you're an emerging fund manager, because I think there's a norms basis. The management fee, the salary will come out of the management fee as well. But it'll be used to pay for our principals and all these other folks that's there. So when AngelList and the commoditization of the legal paperwork will happen through AngelList and all these other platforms to help create funds, then that legal fee dropped, and then you see more emerging funds, smaller funds emerge because the legal fee of setting up a new fund dropped. And so you see some companies now in Southeast Asia, non-public, Optimate, they're trying to do SPVs and other legal automation platforms to lower that fixed cost of running a fund. So I think one thing to understand is that venture capital in many ways was born out of the private equity asset class. Private equity obviously is also a type of fund that's looking to invest in private firms to grow. But generally, a private equity is about medium risk. Each portfolio is expected to generate about 2 to 3x returns on average. And when they buy, they want to buy at least 51%, if not 100% of the entire company. And then they'll probably write a check between $100 million to $1 billion. I'm just generalizing here. These can be larger in the US, for example. And they take over full control, and then they parachute in the consultant, the management team. And I myself have been one of the consultants parachuted in alongside Bain Capital to look at a company that was acquired to realize the full value of that, right? And so the goal is that this company should turn around, fix everything that's been done, take on debt, and so on and so forth. And the goal is to generate about 15% returns year on year. So that's like the target return profile. And obviously the hold period may be 5 years, could be 10 years, but there's a goal of that level of return. For venture capital, it's much higher risk. That means you're supposed to expect in private equity, if you make one investment and the company closes, you'll never work again in private equity for the rest of your life, right? But in venture capitals, wow, 19 of your 20 companies failed, no big deal, right? One of the 19 that failed was FTX, so okay. Doesn't matter as long as your 20th, maybe it's Ethereum or Solana or something else. But I think that's the perspective is high risk, only about 1 out of 20. The norm for a successful VC fund is 1 out of 20 becomes a home run, which will generate about 20 to 100x returns. And normally the VC fund will only have 20% of minority investment. They don't have control. They may have a board seat, but they don't have direct control of it. And then the goal as a result, if you look at that return profile, like 19 failures and 1 giant success, is that the goal for what the LPs are looking for in general is they're looking for a 25% net IRR, right? And for example, if you put your money in DBS, you're getting what, 1% interest rate, whatever it is. So the goal is that if you're an LP, you're supposed to be like a sovereign wealth fund, you need 25%. So this is, but it's very risky, right? Because there's a good chance that this fund may be 20 out of 20 failures instead of 19 out of 20 failures. So this is the risk of that portfolio that's there. As a result, VCs are hunting for home run returns to compensate for these portfolio losses, right? So you're looking for companies that can grow at least 10x, if not 200x. And you also want to come in with a very reasonable valuation. Everyone looks at valuations, the newspaper is like, these are not reasonable valuations. The company I was looking at, they had about $1 million of revenue, all right? They were losing money, but their valuation was $3 million, right? Does it make sense? But if you look at Sequoia, and that's why they became famous in the US, if you look at that, they made an investment in WhatsApp, and it was at $60 million. It's an investment in WhatsApp at 75 times revenue multiple. Think about it, right? Basically, this company was making about $500,000, $500,000 per year, right? For WhatsApp, basically. They put in $60 million, but it was a 75x, and then basically resulted in a 50x returns. Sorry, I gobbled up those numbers, but anyway, the key thing was, it was a very thing. And then they resulted in 50 times returns because Facebook acquired WhatsApp for $3 billion, right? And the reason why was that Facebook was very happy to buy it because it was growing very fast and so on and so forth. And when I was talking to a product manager at Facebook, and I was like, oh, do you feel bad that nobody's using Facebook anymore? And then she was like, no, you're using Instagram and WhatsApp, so it's okay. You're still part of the ecosystem, right? That was a good investment for Facebook, right? If WhatsApp was an independent company from Facebook today, WhatsApp probably killed Facebook by now, right? Probably Instagram as well. And if you look at Sequoia, it invested $100 million in Zoom, and that resulted in 22x returns, right? So I think you can see that these kind of investments can seem very large, but these are quite doable return profiles in the right companies. So as a result, the VC funds in general, the understanding of a VC fund is that investing based on a power law rather than a normal distribution. Most things in life are like the red curve, so there'll be a bell curve. So most things are bell curve. You look at height, is a bell curve. If you look at weight, is a bell curve. In general life, most life is a bell curve in terms of the distribution of that. But in the VC side, it's a function of the power law, right? So they call it 80-20, but they're saying that 20% of investments will make supposedly to 80% of returns, or way more than that actually. But power law distribution is a function of saying that this small number of companies will generate X, 500X returns compared to everything else, and all of this will fail. And so I think this is actually quite interesting because if you think about it, every day, if you're a VC, you're saying no to a lot of people who are average. No. You're above average. You're also no. If you're really good, maybe. And if you're a superstar, they'll invest. I would say that when you're investing in a power law, in some ways, the way you should think about it is like, this is like Manchester United, this is Chelsea or Arsenal. This is like Olympics, right? You're like a swim coach and you're trying to scout for talent. Who will get the gold, right? So if you think about Olympics, right? There's gold, silver, bronze, everything else, you get nothing, right? Most people are not the average swimmers. There's above average swimmers, there's good swimmers. But as a coach, maybe only 10 swimmers that you have that you think has a chance to get the gold, right? So I think that's how people think about that portfolio and how even countries select who gets to represent their country on gymnastics or track and field, for example, because of that portfolio. And so we see that is statistically proven out on the US returns. So for example, if you look at this, that 65% just fell out effectively, then about 25% will get about 1 to 5x. Basically, this company didn't do much with that money, it was just flat. This quantum here, you can say the 6% will be about 5 to 10x. But if you get a company, your home run is this one, your fund is underwater because capital and everything else, and you got 10x, you still lost money, right? So only 4% of companies actually get 10x or more. So this group, if you got one company that's 20x and 19 companies fail, then the math is you basically made back your money. So I raised $100 million and then I got back a return of $100 million. So people are really looking for that 20 to 50x, which is about 1.5%. This is the home run that people are really looking for. I think people just have to really understand that VCs are not altruists. They are not general coaches. They are generally, you better think of them as high performance scouts. and coaches. They're very similar to talent agencies. So you imagine like modeling agencies or Hollywood. You're looking for who's going to be the next Ryan Reynolds, the next Brad Pitt. But these people will capture outsized returns at the top of it. And then everyone else, there's a lot of B-list. And then there's a long tail C-list actors and actresses, right? So there's very few A-list actors who capture most of the returns in movies. So as a result, if you think about the power law, there's another analysis that was done by Horsley Bridge. So basically, 6% of deals produce 60% of returns and half lose money. So a nice way of looking at it is like, this is gray, is like this column is deals done versus the cost of the deals, like how much capital goes in. So there's a number of companies you invested in, the amount of capital you invested in, and then this is the share of total returns, right? And then they separated deals into less than 1x, which is basically dead. Then 1 to 2x, basically a zombie. 2 to 5x is also pretty much zombie, right? Imagine a company grew 5x over 10 years. That's like saying you were making $1 million and you grew to $5 million over 10 years, right? And then this blue line is 5 to 10x. And then over 10x is 6%, right? So this is another kind of cluster. So roughly the number of companies corresponds to the amount of capital to deploy. But if you look at returns, 60% of the returns actually come from over the top 10x. So this is another way of just saying like there is a power law dynamic. A very small number of companies will eventually generate the returns. A very small number of A-list actors and actresses will make most of the money in Hollywood. A very small number of movies will become blockbusters these days. A very small number of athletes will win golds and silvers and bronzes out of all athletes in the world, right? And I think what's interesting is that this VC industry is actually quite similar to a historical industry. It's called the whaling industry. Obviously, it's also similar, has other parallels actually to, again, the Hollywood industry and so on and so forth. But it's very similar to the whaling industries, which is hundreds of years ago. And what you can see here is that these ships will basically sail for 1 to 2 years, right? So they'll leave Boston or Massachusetts, etc. They would have to find a ship, they have captain, they have to get a harpoon. So Moby Dick, the narrator is somebody who signs up to be on this whaling ship. And then the story happens over the course of 1 to 2 years while they hunt a whale that's out there. And when they hunt a whale, they have the harpoon, kill the thing, and then this whole whale will get butchered into ambergris, all these kind of like special products, right? So like oil, meat, blubber, all these other products that were needed. And then these ships would process them and bring them back. If you hunt a whale, which is what VCs use, hunt a unicorn, whale hunting, whatever you want to call it. But basically, if your ship hunted one big whale, you made it. You will go home and you'll be winners. But most ships didn't make it, right? And so you look at this chart on the right, you see here is that if on the red is your whale returns, and then on your yellow is the VC return, right? And you see the risk reward profile is quite similar, right? Which is that if you like 0% or less, that means like 35%, right? And then a bunch of them basically hunted like some smaller whales or some other fish to cover the cost of the ship. Does that make sense? After that, there was like a very small percentage, let's say about 5%, that would basically cover the cost of more than a ship, basically. This person who has 100% return basically said the cost of this expedition, they hunted a whale, and it's basically equivalent to 2 expeditions worth, if that makes sense, of the cost of the ship, right? So now you can fund 2 ships, for example. As a result, even back then, if you read Moby Dick, it's a fun book to read, but people knew there were good captains, people knew there were bad captains, right? There's another character called Ishmael, the harpooner. He's an experienced executive on a whaling ship. And so he negotiates for a higher equity percentage. He was being paid in equity, right? So if this return gets me $1 million, I want basically 0.3% equity. They'll cut off the whale and give him 0.3% of that whale in terms of the cash proceeds, right? So now you're like, wow, but why is it happening, right? So the first thing to understand is that, of course, why is whaling similar to the VC industry? And the reason why is that hunting whales is risky. So either you hunt a whale, a big one, or you didn't. And it's a lot of risk. But if you hunt a whale, you get a lot of money and it pays off for multiple ships. So from a VC perspective, the whaling funders, these were bankers that were paying this, because the captain comes up to them and says, I want to get a ship. I say, okay, I'm going to give you this amount of money. I'm going to give you more money because you're a successful captain before, you've done it before, you know where to go, so you need more money. So they'll give more money, but the price will be higher, right? Does it make sense? Because their expected return is higher. So these whaling banks were basically saying, I need to invest in 20 ships. Because out of these 20 ships, even the more experienced captain may not necessarily land a whale on this voyage, right? So they need to create a portfolio to lower that risk, similar to how a lot of folks today are talking about public equities. You need to be on ETF, you need to be on an index of funds in order to spread and diversify that risk. Of course, the second piece that's important is that if you're a bank and you're paying for 20 ships to go out, you don't have cash to pay them all the money up front. That'll be crazy, right? You can't give everybody that, because if not, everybody's going to run away with your money, right? If you pay everybody, okay, out of 20 ships, I expect one to come back with a whale. So right now, I'm going to give you one whale divided by 20, give you all the money each. 19 out of 20 will just run away with the money, right? Because they already got the money up front. So you need to pay the money when they get the whale. And the people who are comfortable getting paid only when they get a whale have to be people who are very confident or naive or experienced or whatever it is, but they feel like they can get a whale. They're willing to take the risk to have a whale, right? And so these people like the risk, but they feel confident about their performance. And if you think to yourself that you probably can't get a whale, then you're not going to sign up to become a whaling captain or harpoonist or whatever, because you're going to be on a ship for 1 to 2 years, right? And there are stories of captains who are very good or whatever, and then they could not find a whale for 1 year. Then they basically stayed out there for 3 years because they're like, my reputation is I will get a whale no matter what. So imagine you're on a boat, right? You sign out on the boat, you're a captain, and then the captain's, my reputation is I get a whale every single time. So guys, I'm going to spend as long as it takes for me to get a whale. When I come back, I want to be a hero, right? He spends another 2 years, he gets that big whale, but it took him 3 years to get a whale instead of 1 year. So the return profile is lower, but then this captain is the kind of captain that people like, right? For example, right? So people have reputations. So again, it's quite similar, if you think about it, to the VC and the startup industry, is that if you think to yourself, I want to live a chill life, I don't work very hard, I don't believe in myself, you will not join a startup, you will not become a founder. But if you want to be a founder, you're going to be like, I believe it, luck is on my side, I've done it before, I watched The Social Network, the movie, and I think I can do it, right? And people will become founders as a result. Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.